Most people think markets reward skill, better ideas, smarter decisions, harder work. That's the story we like because it feels fair. But here's the uncomfortable truth. Markets don't primarily reward being better. They reward being bigger. And once you see it, you can't unsee it. Because the biggest advantage in modern markets isn't intelligence. The scale. Right now, scale is quietly deciding who wins, who survives, and who never even gets a real chance to compete. And almost nobody talks about it this way. Let's start with something simple. Imagine two lemonade stands on the same street. One buys lemons one bag at a time. The other buys lemons by the truck. They sell the same lemonade, same recipe, same price. But one of them makes more money even if they're equally good. Why? Because scale bends the math. The bigger stand pays less per lemon, less per cup, less per straw, less per mistake. That's not unfair behavior. That's how systems work. Now zoom out. Replace lemonade with oil, or software, or shipping, or banking, or retail, or advertising, or data. Suddenly, scale isn't a detail. It's the whole game. This matters right now because we're living in the most scale-rewarding economy in history. Digital platforms, global supply chains, algorithmic pricing, zero marginal cost products. The gap between small and big has never been wider. And the scary part is this. Markets don't just reward scale, they protect it. Let's break down how that actually works, step by step without jargon. First, cost. Big players don't just earn more. They spend less to earn the same dollar. When you're large, fixed costs spread out. A factory costs the same whether it produces 1 unit or 1,000,000. A software platform costs almost nothing to serve one more user. A logistics network doesn't care if one more box is added. So every extra unit sold is cheaper than the last. This is called economies of scale, but the phrase hides how brutal it is. Because it means the largest company can undercut prices without trying. Not because they're greedy, not because they're evil, because their math is different. A smaller competitor sees a price war. The big player sees margin management. That's the first reward. The second reward is access. Scale opens doors that skill alone cannot. Banks lend more cheaply to large firms. Suppliers offer better terms. Governments listen more closely. Media pays more attention. Not because these institutions are corrupt, though sometimes they are, but because large players look safer. And safety attracts capital. This is one of the quiet ironies of finance. The companies with the most money get the cheapest money. A startup might pay 12% interest. A giant corporation might pay 3%. Sometimes less. Same dollar. Very different price. Over time, that gap compounds. The third reward is tolerance for mistakes. This one matters more than people realize. Small players must be right almost every time. Big players can be wrong and survive. If a small firm launches a failed product, it could be fatal. If a giant fails, it's a line item. They can absorb losses. They can experiment. They can wait. Time itself becomes an advantage. And markets love patience. Now here's where things get uncomfortable. Once a company reaches a certain scale, it no longer has to compete the way others do. Competes asymmetrically. Think about this. A large platform can run one part of its business at a loss while another part quietly pays the bills. To an outsider, it looks irrational. To competitors, it feels predatory. To the market, it's perfectly logical. Scale allows cross-subsidy. And cross-subsidy destroys narrow competitors. This is why niche companies vanish even when customers love them. Not because they're bad, because they're boxed into a single revenue stream. Now let's talk about the hidden mechanism most people miss. Feedback loops. Scale feeds on itself. The bigger you are, the more data you collect. The more data you collect, the better you optimize. The better you optimize, the more customers you attract. Each loop strengthens the next. This is especially powerful in digital markets. Search engines, marketplaces, payment networks, social platforms. They don't just grow linearly. They curve upward. Once the curve bends, late entrants are fighting gravity. And here's the quiet joke. We call this competition. But at a certain point, it stops being a race and becomes a lock-in. Users stay because everyone else is there. Vendors stay because users are there. Advertisers stay because both are there. Leaving becomes costly. Not financially at first. Psychologically. Now let's contrast hype versus reality. We love stories about the scrappy newcomer, the garage startup, the disruptor, the underdog. And yes, sometimes they win. But what those stories usually skip is this. Most successful disruptors don't beat scale. They build scale faster than incumbents. They don't escape the system. They inherit it. Once they're large enough, the same rules apply. They cut costs. They leverage data. They negotiate harder. They dominate attention. The myth is that innovation replaces scale. The reality is that innovation is often just the on-ramp to scale. Now zoom out again. What does this mean for markets as a whole? It means concentration is not an accident. It's a natural outcome. Left alone, markets tend toward fewer, larger players. Not because competition fails, but because competition selects for scale. This creates a strange paradox. Markets are supposed to reward efficiency. Scale creates efficiency, but extreme efficiency reduces competition. The system does exactly what it's designed to do, and then we act surprised by the results. There's also a risk hiding here. When scale dominates, resilience drops. Large systems are efficient but brittle. A small failure spreads fast. A single decision affects millions. A miscalculation echoes globally. Think supply chains. Think financial networks. Think cloud infrastructure. When everything is optimized, there's no slack. And slack is what absorbs shocks. Now bring this back to you. Whether you're an investor, a worker, or a business owner, scale shapes your outcomes more than most advice admits. It explains why wages stagnate in competitive labor markets, why profits concentrate at the top, why small businesses feel squeezed even in good economies. It also explains why regulation always lags. By the time scale becomes visible, it's already entrenched. Breaking it up feels disruptive. Letting it run feels dangerous. There's no clean answer, which leads to the final uncomfortable question. If markets reward scale more than skill, and scale naturally concentrates power, and concentration reshapes society, at what point does a market stop being a market and start becoming infrastructure? And if that line has already been crossed, who should be in control of it?